Hello guys, this is Solanki and today we'll be talking about mutual funds and ETFs. Mutual funds are subject to market risk. Please read all scheme related documents carefully. You might have heard this disclaimer a lot many times. So in this video, we'll be talking about what is a mutual fund and we'll also talk about what is an ETF. Now many people get confused between ETFs and mutual funds, so we'll be solving all those doubts, and this is the third episode in the stock market series. So if you haven't watched the first two episodes, then do give it a watch right now, and let's start with this video. So the first thing that I want to talk about is what exactly are mutual funds. So mutual funds, as the name suggests, it is a mutual collection of people's money, and that is invested in some companies, stocks, shares, or even ETFs. Let me explain it in much simpler sense. So say for example, I have a group of 10 friends, right? Each one of them is ready to invest 1000 rupees. Now they all do not want to get into the stock market, do not have time in order to track the markets, and that's why they give that responsibility onto me in order to invest their money. So there are 10 friends, so each one of them is investing 1000 rupees, so a total of 10,000 rupees is currently with me. Now this 10,000 rupees can be considered as a fund. Now this fund is then invested. So I, being the fund manager, I will be deciding where should this money be put in. Say for example, I then decide that this particular fund will only invest in large cap stocks. So large cap stocks basically means that stocks which have a very huge market capitalization and they have a huge company. So I pick some stocks, I pick HDFC, I pick ITC, I pick Tata, Infosys, and all of these really huge companies. After that, I allocate percentages to each of these stocks and then I invest in those stocks accordingly. So 10,000 rupees I've invested in all of these stocks. So basically the fund is now diversified into large cap stocks. And now this fund will be called as large cap fund. Say for example, my name is attached with it. So Ali's large cap fund, right? So anyone else who wants to invest in this fund can then see its past performance and then they can invest in it accordingly. So this is what a mutual fund is basically, right? So there is a group of people who want to invest in one particular sector, and that is how a mutual fund is formed, and they then invest via a company. And then each of these companies or each of these funds have a fund manager who is an expert when it comes to picking a stock. So if you're a person who does not have a lot of time in picking up stocks and analyzing the stock market, then going ahead with a mutual fund would be the best step for you. But now what is the benefit for the company who's actually managing these funds? So basically each of these mutual funds have an expense ratio. So what is an expense ratio? It is basically a small percentage which you have to pay to the mutual funds in order to manage your money. So say for example, the expense ratio is 0.1 for my mutual fund, and the total amount of money that I'd collected was 10,000 rupees, right? So roughly I would be getting 100 rupees from that 10,000 rupees lot. Now of course there are other charges along with it, but I'm just simplifying the entire process for you. Okay, so now you've understood what a mutual fund is, how mutual fund companies actually make money, and all of these different factors as well. So now let's get into what are the different types of mutual funds. So the most common type of mutual fund that you would be seeing in the market is an index fund. So index fund basically tracks the indices. So there are a lot of indices out there in the market. Most common ones are Nifty and Sensex. So Nifty is the collection of top 50 companies in India, and Sensex is the collection of top 30 companies in India. Now if you look at the US stock market, there are different indices like Nasdaq, there is S&P 500, and there are a lot more. So if you are investing in any of these index funds, then your money would actually be distributed among the top companies in those indices. Just imagine if you wanted to invest in the top 30 companies in India, how much capital you might need in order to pick each of those stocks. But here all your problems are solved by just investing a small amount, and that amount is then divided into all these top companies. So that was index fund. Now apart from that, we also have different types of debt funds or bonds. So debt funds basically invest in different bonds. So there are some government issued bonds that these debt funds can invest in, and debt funds are generally considered to be a safer option than investing in the equity market. And especially when it comes to a market crash like this one, then debt funds usually perform well. Apart from that, there are a lot many mutual funds. There are large cap mutual funds which only invest in large cap companies. There are small cap funds, there are mid cap funds, then there is a liquid fund. So liquid funds basically keep your money and you can actually invest or redeem your money whenever you want. So with other funds, you have to wait for some time in order to redeem your money, but with liquid funds, you can redeem it whenever you want. So these were some of the types of mutual funds. So once you've understood the entire scenario with mutual funds, going over to ETFs would be really easy for you. Now ETFs are similar to mutual funds, but they are exchange traded. So ETF basically stands for exchange traded funds. You can basically buy or sell them just like a stock. There is no fund house that is actually managing these funds. And even for the expense ratio, there is almost no expense ratio over here as well. Apart from that, whenever you are investing in ETFs, just make sure that the volume in ETFs is also high enough, because when it comes to mutual funds, the mutual fund managers will always give you the money whenever you're trying to redeem it, right? Whenever you're trying to sell your units that are allocated to your fund, you'd be able to redeem it and you'd be able to get money out of it. But when it comes to ETFs, because ETFs are traded on the exchange and they are just like stocks, when you try to sell them, there should be someone else who's ready to buy it from you. So make sure whenever you're buying an ETF, you're looking at the volume. Volume basically means how much buy and sell of that ETF is currently happening on the exchange. If there is no trading activity that is currently happening, then investing in those ETFs would not be the best choice. But right now, if you look at ETFs and mutual funds, if you're trying to invest in an index fund, then I would suggest to go with a mutual fund itself, because the difference of expense ratio that you're trying to save by just buying an ETF from the exchange traded market is not that high when it comes to index funds, right? So you can also do SIPs when it comes to mutual funds, but you cannot do that when it comes to ETFs. SIPs are systematic investment plans. So basically, if say for example you want to invest 5,000 rupees every single month in a mutual fund, then you can do that. You can actually have an automatic deduction from your bank account. If you want to know how I have divided or invested in all of the mutual funds that I currently have in my portfolio, then you can watch this particular video in which I've talked about my entire portfolio in 2022. So do give it a watch. So that's it for this video. If you like this video, then do press the like button, do subscribe to this channel by pressing the bell icon, and comment down below if you're going to invest in an ETF or a mutual fund. Let me know in the comment section below why you've chosen that.